Welcome to this video from efinancialmodels.com. In this video, I'm going to explain how to analyze the acquisition of a self-storage property and how to find out if there's an opportunity to create value. What is self-storage? Self-storage is a commercial type of real estate where there are small storage boxes are rented out either on a temporary or permanent basis to private or business customers which are in need of additional storage space. These spaces can either be rented and priced by area or also by volume. Typically, customers will accept a driving distance to the property of about 10 to 20 minutes, so one should have a look at the population number living close by. Self-storage itself is a concept which I believe was initially developed in the US and Canada, and in the recent years also has become more and more common in Europe. So let's get started and let's dive into the analysis. What we will need is a financial model to perform our calculations. I get here one from our website, efinancialmodels.com. And in this model, what we will need to do first is we need to collect all the assumptions required, which we will input into our analysis. The first set of assumptions is related to the property, the specs of the property in terms of the size, the land, the available space, the net leasable space, and the number of units which can be rented. Then we also need to know how many of these units or how much of the potential rental income currently is realized. For this, we will need to also understand what is the current occupancy rate. And we also want to understand what's the population living nearby in close driving distances. The second set of assumptions we want to collect is the current situation on the rental income and on the costs of this property. So we will collect information. What's the current rental income? Are there any related revenues obtained from selling services or from renting equipment, moving equipment, or anything else? And then we also need to know what's the operating costs to run this property for security, maintenance, etc., etc. And this will give us two figures. It will give us the revenues and the net operating income currently achieved today with this property. What we then also can calculate is the average rent. So we want to know what's the current price we can rent, or these spaces are rented on a monthly basis. The next set of assumptions we need to do is we need to enter what will be our acquisition budget, how much we'll have to pay for the property, what's the capex budget we have to reserve to do changes, to improve the infrastructure, to add additional spaces, to remodel things, etc. Then the fees we have to pay to get the transaction closed, and also eventual cash buffers and reserves we have to reserve. Then the next topic will be we'll have to think about what we can do with this property. And there are different drivers or levers we should target to influence. One is the occupancy rate. So here the question is, what will happen if we increase the occupancy rate? In this case, 75, let's say we move this up to 80%. When can we start to increase it, and when will all the new occupancy rate be achieved and stabilized at that? So maybe it can be 80, but also, of course, one should try to maximize this. For our purpose, let's leave it at that. Then the next question is the rental rate. Is there an opportunity to increase the monthly average rental price? If yes, we update our rental target. We say basically when it is possible to do that. If we find that the increase, for instance, can happen after we increase the occupancy rate, in that case we could start in month 18. It will take, let's say, only 6 months, and then the average occupancy rate is stabilized at 1.85. I'm now changing this to blue colors because this is a hard input. If, as you can see, if it's a light blue, then this is still linked, but the idea is that it's an invitation to overwrite this and replace it by hard inputs. These are the cells to apply the changes. Then the next level are the ancillary revenues. Here there might also be an opportunity to sell additional services, generate additional income. We estimate this as a percentage of the rental income. So if there's an opportunity to increase that percentage, we can enter it here. We can also say when this will be realized. Maybe this can be done a bit earlier. And also the 5% stabilization can achieve after quite a while earlier. So we can also model that. Then what we will need is we'll need to think about what will be the costs to operate this building. So we can here list our budget. These are mostly fixed costs. So we try to figure out what will be the yearly cost and what does this mean in terms of the monthly costs. Then additional assumptions, you have here income tax, capital gain tax, that would be upon exit. In case there are receivable payables, we can all enter that. And then the last area we have, or the last two topics we have to think about, one is financing. So we said we have here our acquisition budget. These two items, they should serve as collateral by banks, so we can obtain we might be able to obtain some debt financing. We can say how much of the total of this amount we think we can obtain, and we can enter here the percentage. And if this is a bit higher, you see that then the required equity amount goes down. Also, if we play around with the cash buffer, this will, now it's too much. This will change, or what we also can do is, if we want to round this, we can go to goal seek, and we just say, okay, let's take a rounded number, and we just correct here the difference via the cash buffer. So let's work with a rounded number here. So that's equity 1.9 million to be inserted. As you can see, we have two layers of financial debt. They might come at different interest rate. Some might be paid in cash, some accrued. And then there is also the question if the debt has to be repaid or not. And we can play around here with these assumptions. This is a template only, it might need some customization. However, for an initial analysis, this should be good enough. We should just try to keep things simple. So basically, this is all updated. Now we'll have to see what are the effects on the financials. Actually, the calculations in this model, they're all done on this forecast sheet. We have here a monthly forecast over a period of 5 years. This is then all aggregated in a 5-year yearly forecast. This is a bit too detailed. So what we're going to do is we're going to review the results on the executive summary sheet, where it's a bit easier to follow. So what we first want to do is we check here the forecast. As you can see, the occupancy rate increases, so the revenue should also increase. This is reflected here. The average rent also increases. This also is another contributing factor. And then we also said that the ancillary revenues should increase. And here you can see we're making more revenues. And overall, this means actually the revenue is increasing from where we started to where we want to go. Now, the other thing is that the OPEX budget is quite getting high. Here there are some extraordinary costs due to acquisition, but then you can see that these costs are significantly higher than before. So maybe our OPEX budget is a bit too high. Let's reduce that a bit. So we can adjust. We can also play around with inflation. Here I've assumed inflation, but to keep things simple, let's put inflation rates to 0. And so in this case, that's what I want to show. Let's say the OPEX only slightly increases, so net effect is that we can increase the NOI by about $80,000 a year in this example case. Then what we want to understand is the effect on the property value. So at the beginning, that is what we have to pay to acquire the property. We'll do some capex. This increases the value. But then also here the exit valuation, what we assume here is that we are exit the property in about, I think, 5 years. There's another set of assumptions I've skipped before. We have two exit scenarios. Here we are currently focusing on the trade sale. We can say this happens in year 4, year 5. Whenever you choose to do, we can say what's the net cap rate. We value the property, transaction fees we need to take into account, etc. What we are doing here is that we acquire the property at a 6.5 net cap rate, and here we're selling it at 6% cap rate because it's more stable and more developed, so it's less risky. That would be the argument here. However, yeah, this is something to think about every time again. What will be a realistic cap rate for this property? And then you can see that the effect is we have higher NOI, we have a lower cap rate, ergo the property value goes up. What does this mean in terms of the equity value? So you see there's a difference here, and basically this difference goes right through to the benefit of the equity shareholders. So that's why they are benefiting quite a lot. And then here we can also see the summary. In that example, property value increases by 20% in this. But then if you look at the in terms of the cash flow perspective, there's slight difference in multiples, but the effect here will be that the this one is unlevered, and this one are the levered cash flows and metrics. And you can see that levered we need less investment, we have the profits, and then we should get these proceeds. So this translates into, in this case, a 3 times multiple. You can see IRR starts to become quite attractive, and basically this would mean this is just a simulation how this would benefit. This means it's quite should be quite an attractive project. Then what we also want to understand is why did the property value go up? So we have here a list of all the factors. We start here with the net cap rate. If we change the net cap rate from 6.5 to 6, you can see that alone was this effect. We have higher OPEX from the beginning where we started to the end. So that's why we were here. The value will go down because we have a bit higher OPEX. Ancillary revenues, we have additional revenues. If they're capitalized, the property value goes up. Prices, higher prices, revenues go up. And same with the occupancy rate. So you can see a bit the effect of which factors or which actions led or contributed to the increase in the property value. That would be important to understand. This basically would give you a picture on what the most likely financial scenario could look like if you would enter this property today, and 4 years later you would 4 or 5 years later you would sell the property again. Now what we also want to study is, let's say we can play around with the exit year if that would change something. If not, we'll be fine. The other scenario we want to look at is the refinancing scenario. In that scenario, we're not going to sell the property, but we're going to do is we try to refinance the existing debt, and now the refinancing will happen at a higher property valuations. In this case, 65, or maybe we can even get 75% of the property value down the road in 5 years. And then we want to compare again, and you can see property value is unchanged, but what changed is the equity value. In this case, it's a bit, we can only obtain cash for 80% of the property value, so that means we have a bit less cash receipts, but the equity value realized is still telling us that we should make money when following this strategy. This is a bit an example how this could be analyzed, and now the next task would be to play around here with the assumptions and study how this reacts. And also, if we have scenarios which might not make sense or so, then the task would be to go back and figure out why this is like this, or what influences the results you get here, and if by doing this during this process that you learn more and more and get a bit more a feel and a sense how the evaluation of this property might react. So I hope this was useful. I hope you liked this video. If yes, please give it a thumbs up and hit the bell button to subscribe to our channel. Please also visit our website efinancialmodels.com. A link to the model template is included in the description below. Thank you for watching.